Sorry if I take up too much time on this one topic, but let me talk about it a little bit further because I think it's a great example. In my family, I have a family of 5. And years ago, we were on an HMO, like just about everybody else. But the HMO costs continue to get higher and higher, the premium costs. And so for my family of 5, I was spending probably about, I think at that time, about $1,200, $1,200 to maybe even up to $1,500, I forget now, but it was quite a while ago when I made this change. And so let's just figure it's $1,200 a month in premium for a family of 5. To go with an HSA, or to go with a high deductible major medical plan, it was $450, as I recall. So my savings there was 600, what is that, 650 bucks? Something like that, pretty close?
750.
750, thank you. Yeah, see, you know, I should pull out my calculator right now and start calculating something. But in any case, 750 bucks a month. Now, my deductible was $3,000 for the entire family. And after the deductible was met, everything was paid for 100%. So it doesn't take really a whole lot to really calculate that at $750 a month in monthly savings, how many months did it take before I had saved enough to cover that $3,000 deductible? And now all of a sudden, I could build that savings into this HSA account. There are some limits on it, keep in mind. Right now, the annual limit on what you can contribute to a HSA is $6,450 for a family, and it's half that for a single or for an individual. And what's different about an HSA versus a flexible spending account or a pre-tax reimbursement account is, or a cafeteria plan, these are different names for the same tool. Under those plans, if you don't use your money by the end of the year, you lose it. The employer keeps that money. It's part of the law. It's just the way it was written. So they had this use it or lose it rule. With an HSA, you can carry your money forward year after year after year. And it continues to build in a tax-free way. And as long as you use the money for medical, dental, eyewear, that kind of thing, you pull it out completely tax-free. If, by the way, you don't need it all for medical expenses, you can pull it out and pay income taxes and use it as a supplemental retirement income source. So that's another benefit of the HSA. I have clients who max that out every year and don't necessarily use it all, but unfortunately we have other clients who will use that year after year after year and use the whole amount annually. But it's a tax-free vehicle that a lot of people aren't aware of. Did I answer the question?
Yep.
Okay, probably more than what you wanted, right, Jake?
Well, there's a lot to it, and we understand that even today, we can't drill down so deep into things to answer your specific questions because in the financial services world, with laws changing, regulations changing, just the volatility, the risk tolerance that you're dealing with, everybody's a little different. So we're trying to cover the major topics that may have an impact or be a major challenge or a concern with you as you're going through your journey with cancer. That brings me to a question that is the opposite of the hidden out-of-pocket costs, and that is when you have run out of cash, how do you convert property, whether it's investment assets, property, maybe the cabin up north, it may be something that you have as far as land. How do you go about doing that so you create more cash instead of having all these properties that you may never use or you may need to try to get a loan for and you can't, but how do you convert that into cash?
Very carefully. I'm just teasing. He had a one-liner earlier. He just kind of left it out there and no support. That's okay. No, it's kind of funny. So actually that reminds me of another story. But in this particular client's case, they didn't have cancer. They had just lost their job and they were in between jobs basically, and they had run out of their cash reserve assets. They were now, those were depleted. And his question was, what's next? And he actually wasn't the client at the time. He was referred to me. He was a prospective client, and he called in a very panicked mode and said, oh my gosh, I'm out of money. What do I do next? In his case, just as an example, what we did is we took some tax-deferred money. He had money in a 401k with his former employer that he rolled to his IRA. And one of the advantages of having money in a 401k plan is that you can borrow, if the plan sponsor set it up this way, you can borrow up to 50% of your balance, up to 50% of your vested balance of the 401k, but there is no loan provision in an IRA. So what I suggested to him, by the way, it wasn't the first suggestion. The first suggestion was to look at how can we refinance your mortgage and, you know, maybe get some equity out of that house. And the end result was because he didn't have income and his spouse wasn't working outside the home, there wasn't an income source for the mortgage bankers to be interested in refinancing under what they call a cash-out refi. But his rate was high enough that it still made sense to reduce the mortgage or reduce the interest rate by refinancing the mortgage. So we could do a refinance, just not take out any cash from the equity. So by doing the refinance, we reduced his mortgage payment by about $1,000 a month. So that was a huge benefit. And then the second thing we did is because while he was out of work, he was starting to do some consulting work. So we set up a company, we set up an LLC, a limited liability company for his consulting practice or business, opened up a 401k plan. We call that a single K plan because it's just him in the business. And it's just like having an IRA. There aren't all these administrative fees like you would see on a normal 401k. It's just a single K. We rolled this IRA back into his 401k and then took a loan against, or are taking loans, I should say, against his 401k to subsidize what his living needs are for the short term. So this isn't, these are just ideas, and I don't expect you to know these ideas. This is what I've spent my career learning these various concepts and strategies, but just know that you're not alone. There are people out there that can help you solve your questions, solve your issues. You know, I think of also as Michelle was talking about, she's a problem solver. That's kind of the way I think of myself. My job is to see what's going on right now, help you define, if you haven't already defined, what your goals are, and then what are we going to do to get you there. And what you were just talking about was the goal of freeing up cash flow so that you can afford your current lifestyle. Part of that discussion is how do we change your, well, not necessarily change your lifestyle, but how do we positively affect the expenses that you have on a current basis? And again, back to that example, in this person's case, we're able to reduce their expenses and free up cash that they didn't know how to free up. That's just, again, a couple of examples. There's more, for sure.
You stated earlier that you have some clients that have cancer or families that have been impacted by survivors that have gone through their cancer journey. What were some of the challenges that they had or fears that you had helped them with?
You know, it's been said before. You know, I think their first fears are, how am I gonna afford this? You know, what it depends on who the person, which spouse has the cancer or the situation. It doesn't have to be cancer. It could be again loss of job or, you know, something happening in their life. So when I think about it being the person who is the primary breadwinner in the house, I think their reaction to this is, how am I going to afford it? Maybe the non-working spouse has the same reaction, but just from a little bit different perspective. So I think that's number one. And the good news is that that's my area of expertise. So I'm able to say, this is how we're going to be able to afford it. It also reminds me of another example of a client of mine who was just in two days ago, and his wife has cancer, stage 4. Now, she's had stage 4 for 4.5 years. So congratulations, she is beating the odds, and she's stable and continues to be stable. And when we talk about planning, and it doesn't matter that you've got this disease, it does, don't get me wrong, but when it comes to planning, thinking about life together for the long term is important. And then planning for contingencies along the way is also important. And whether you had cancer or not, those are the conversations that I try to have with people to say, what are you striving to do in your lifetime? And by the way, if you become disabled, here's maybe a hole that you might have in your financial plan. If somebody dies, here's another hole that might be in your financial plan. Or maybe they don't have a hole, Maybe the answer is they got plenty of insurance coverage, they've taken advantage of group insurance policies, they got their own individual policies, all that kind of stuff, and they don't have a hole. Sometimes it's you're spending more on those expenses than you need to, and we can now pare that down in favor of adding more toward building wealth for these future goals that you've got. So why that couple came to mind when Jake asked this question is because they have a plan, and the plan is life. And they know at some point they're going to die. We're all going to die. Don't know when that's going to occur. So I'm just going to use expected mortality or even further to be more conservative. And then once we put in place the plan to get to that goal, to have that retirement goal together in a healthy, happy environment, I'm still going to do these contingencies related to this plan. Death, disability, long-term illness, health insurance, which is separate from long-term care when we talk about insurance products and so forth. Oh, by the way, I do want to mention this before I forget. Another thing that we did for some of the folks that we work with that have some illnesses and so on, we look for credit, life, and disability insurance. A lot of people are totally unaware of that. You may have elected it when you took out your mortgage. You may have elected it when you took out your credit card, took out that credit card, or you might not have elected it. And so maybe what we do is we apply for a new one and get that offer of coverage, because credit, life, and disability insurance is guarantee issue. They don't look at your medical history. You just check the box and pay the fee, and we're off to the races. So it's making sure that we're utilizing what's available to you, and maybe doing some things that you never would have thought that you would have done in order to be able to get the coverage, hopefully that helps.
What are some false assumptions that some of your clients had, or unrealistic expectations as they've gone through cancer and they come to you either looking for answers or just wanting to converse over it?
Well, I've kind of said it already. They think that there might be nothing that they can do. I mean, isn't this the 11th hour, Jim? Isn't this haven't I already made my bed and now I've got to lie in it? No, not at all. I mean, here's another story of somebody who didn't have cancer, and he's 62 years old, and he said, I always ask people when do they want to retire, but usually before I say that, I say, besides today or tomorrow, when do you want to retire? And this person actually was serious. He said, hey, I want to retire today. I'm 62 years old. I want to be done. And they said, well, you don't have enough resources to be able to do that. So let's map out a plan on how we can quickly get you there. And so at age 66, he was actually able to retire. So he did virtually nothing up to age 62, but between 62 and 66, he did quite a bit and was able to retire in the lifestyle that he wanted, or at least close to the lifestyle that he wanted. So my answer to your question, Jake, is that the fallacy is that there's nothing that you can do, and there are 1,000 things that we can do. In fact, before I forget, I'm going to mention this too. I shared this with Jake a while back, and I read lots of journals and publications within the financial world, and here's one that I thought was really great, and so I took a snapshot of it, and you can write this down if you want to Google it. It's called 35 Money Leaks, and it was in CNN Money magazine. And I know if you Google it, you'll get there, because it was the first thing that came up on Google like 2 days ago when I Googled it. So 35 money leaks, and then there's an ad on and how to plug them. And just some of the ideas here, just simple little things like, let's say you've got a cell phone and you're using that and you're not using your home phone anymore. Why not just get rid of that expense? Get rid of the home phone. You don't need it anymore. I know when cell phones first came out, they weren't as I'm trying to think of the term. They weren't as good. I don't know. Say it again. Reliable. Thank you. Yeah. So, but today I think they are. Now maybe in your house your cell phone doesn't work. Okay, if that's the case, it is what it is. Take for example your cable bill. Now they've got Netflix out there and other things, Hulu and all these other things. And I am not an expert on any of that stuff. But if you've got cable TV and you're spending $100 or a couple $100 even on cable TV for premium channels and all this kind of stuff, you could save a whole bunch of money just by getting rid of all of that and signing up for $8 a month on Netflix if you really like movies and you want to be able to tap in on a real-time basis to that. Netflix is streamed video over the internet. So as long as you have an internet connection, you can play it on any computer or play it off of your your DVD player on your TV or a TV, internet-capable TV, whatever. So with all these new enhancements and stuff, there's a lot of ways to save money that way. I don't know, those were just a couple that came to mind. But like I say, there's 35 of them in here that are just kind of like ahas. I think that we could, figure out ways to just reduce those current daily expenses.
Okay, do you have any final points that you'd like to make before we ask
Well,
a few questions?
let me look at my list here real quick. So I just talked a little bit about cash flow and how to save money there. How to build net worth. We talked about, different ways to build money, different taxable and tax-free and tax-deferred ways to build wealth. Cash reserves. I wanted to make a point about cash reserves real quick. So many people leave their money in the bank at today, 0.0% rate of return. Maybe it's 0.02 or 0.05, or maybe at the highest it might be 0.2%. How about if we just put it into a short-term bond fund that's paying like 1.2% or 1.8%? Short-term bonds, very stable. And in fact, the one I'm thinking about is a municipal bond fund that we use a lot, and it pays 1.25% tax-free compared to a 0.02% cash return at the bank. That's taxable. So there's a way to just take even a little bit of money that you might have in cash reserves, or maybe the large amount of money you might choose to have in cash reserves, and just get a better return on that. And I talked about the different kinds of insurances and things. Property casualty insurance is another one. Property casualty is auto, homeowners, personal umbrella. Shopping that on an annual basis is important, because a lot of times what I see is carriers will kind of buy the business. They'll give you a good rate up front when you first quote them and you sign up with them, and then over time they start ratcheting your premium up. And if you're not shopping that periodically, you're probably paying more than you should be for your coverages. Another thing related to that is lots of people have low deductibles. And if you have a $100 deductible on your car, or even a $500 deductible on your car, depending on your financial situation, you might be better off going with a $1,000 deductible. I've heard this before, where people will say, well, what happens if I need to replace my windshield? Well, in the state of Minnesota, you don't pay anything. The windshield glass coverage is covered 100% in the state of Minnesota. It's required by law. Each carrier has to provide it, and therefore you don't have to have a low deductible to be able to replace your windshield when you get a rock chip in it. So when you start thinking about how that coverage is used, in fact, I was talking to a property casualty agent last night on a particular issue, and we were talking about stacking coverage, where a lot of people they think it's a great idea to stack coverage for personal injury. So what happens is that by in essence borrowing from parts of the policy, you can get more coverage under personal injury protection if you stack it. The problem is that costs a couple $100 extra per year, and at the same time, you already have, hopefully, medical insurance that's paying for those same types of expenses. So in essence, that $200 a month in additional premium cost is a waste of money. You're not going to get anything more. Your insurance carrier, your health insurance carrier, is going to be the primary payer, and your auto insurance carrier is going to be secondary in every case. So you're paying for something you don't need. So just analyzing that stuff is, in my opinion, pretty important. Let me just make sure I got it all. Oh, estate taxes. Well, okay, back up. Income taxes. I'm an 80-20 rule kind of guy, and I believe that about 80% of the tax code was meant for businesses, and about 20% of it was meant for us as individuals. In fact, now I think it's more like 90-10. We don't have a whole lot of ways to save money on taxes as individuals these days. So interesting enough, people will come to me initially, and they tell me they've got this hobby that they really enjoy and so on. It's kind of amazing how many times those hobbies turn into businesses. Because if 80% of the code is limited to business owner issues and ways to save money on tax code by being a business, let's turn that hobby into a business and utilize more of the code to reduce your tax bill. Enough said on that for at least now. And then estate taxes. Estate tax, in my business, we oftentimes call it the dummy tax. Excuse me for the slight. But estate tax is the tax you don't have to pay as long as you set your estate plan up correctly to avoid that tax. The federal government just finally figured out what they're doing related to estate tax, and they now have capped the extent or the unified credit to just over $5 million. It's actually $5.12 million today. But the state of Minnesota has a $1 million credit. And you might say, well, I don't have $1 million, Jim. And that's probably not true. When you figure out not only your assets, your investment assets, but your house and your insurance policies, and this is the big fallacy. Most people assume that their life insurance policies are not subject to estate tax. When that insurance agent sold you that life insurance policy and said it's tax-free, what they meant is that it's income tax-free, not estate tax-free. So it gets included in the taxable estate. And if you add those up, chances are you might be close to or maybe even over $1 million. For a lot of folks, that happens, and they're just unaware of it. And unfortunately, in the state of Minnesota, we have a state death tax, and there are ways to avoid paying that tax if you do something with your will documents and put the right language in it prior to something happening. So I can't stress enough that we need to be thinking about that as well. You do need to think about that ultimate exit strategy, in my opinion. Enough said. I know I took too much time. Apologize.
Nope, you're all right.
Okay.
Okay, questions for Jim? Yes, sir.
Hi, Jim. When I was employed, I always put money in the health savings account, but once I got laid off there and retired here, what's the mechanism for doing that now? I didn't know there was a mechanism.
You can have an individual health savings account. You don't have to have it just through your employer. So if you have a high deductible, there's two things that have to come together in order to be able to take advantage of a health savings account. The first thing is the law says that you have to have a high deductible major medical plan. And so, remember years ago, you said you were dating yourself, Jean Marie. When I first got into this business, everybody was on not maybe high deductibles, but they were on major medical plans. And then HMOs became the wave of the future, and everybody got on HMOs because it was all about preventative care. And now we're back to, major medical plans with deductibles. So the feds have rules around this. For the most part, I would say that in order for it to be considered an HSA-eligible medical plan, the deductible has to be, let's see, I think it's, don't hold me to this, don't quote me on this, but it's somewhere in the neighborhood of around about $1,500 for an individual and $3,000 for a family. And I know that number is changing because it gets indexed with inflation, so it could be off just a little bit. So once you have this high deductible major medical plan, then you can open up an HSA. And you might open that HSA up with the carrier that offered the medical plan, or you have the right to open it up with anybody else. In fact, this is kind of a funny little story. One of the largest HSA vendors in the United States is called HSA Bank, but their original name was the State Bank of Howards Grove, Wisconsin. A little state bank in Howards Grove. You've never even heard of Howards Grove, Wisconsin, and we live in Minnesota. So it's just a little bank that jumped on, this whole idea, thought that, oh my gosh, so this is probably something that's going to take off nationally. So we're going to meet the demand, and they were right there at the right time. And so here's a way that you can build up money and you don't have to have it at that bank. You could have it at Wells Fargo has an HSA program. U.S. Bank has an HSA program. Medica, through their Optum company, has an HSA program. Blue Cross Blue Shield, through MII Life, their life insurance arm, has an HSA program. So there's lots of HSA plans that you can tap into, or accounts that you can set up. And why I like HSA Bank and some of these external ones, and I know Optum has this as well, is that when you build this thing up, let's say you build up $10,000 or $20,000 in it, you don't want to keep that money in cash. Do you really want to get, cash rates on that money? You'd rather have that get invested. So you could set up a self-directed brokerage account inside your HSA so you can more fully invest those dollars. And I know the two that I just mentioned offer a self-directed brokerage option. Does that answer your question?